at the reporting framework in the previous video. We are going to look at the different IFRS one by one. We look at those IFRS that are still on the new syllabus. IFRS on the new of paper 13. We look at those that were removed, those that are still there, and we'll try to understand what we are going to be covering. Remember, this is still the introduction. We are basically looking at the course outline. We haven't started looking at the notes, but we are basically focusing on the course to be diving into. On the syllabus, we have IFRS 1. IFRS 1 is presentation of financial statements. Presentation of financial statements. It is the same like IS1, though, as I said, some of these, it is basically the terminologies that are being used that are going to be differing. So, IFRS 1 is still on the syllabus. So this is a very similar standard to the, as I said, it is similar to IS1 in the private sector. It is very similar to IS1. And within this standard, there is no difference in the treatment. Within the treatment, once you are, the way we treat things within the IS1 is the same way we treat the terminologies. The only difference is within the terms that are used. Terminologies used are going under the IFRS 1. They are different. They are the ones that are going to be changing a lot. For example, where you, let's say once you talk about, where you talk about retained earnings, where you talk about retained earnings under IS1, here we shall be talking about accumulated surplus. Accumulated surplus. So the retained earnings will be replaced by accumulated surplus that are going to keep on changing. We shall understand why we are changing the names. Because we know that retained earnings, those are profits that we kept on accumulating throughout the period within the private sector. But in public sector, we don't, these companies or these private sector entities that we have, they are not there to make profits. That's why we don't have retained earnings. We have accumulated surplus, where we get the revenues minus the expenses to get either a surplus or a deficit. So it is either surplus that we keep on accumulating, or it is going to be where we got a deficit. So that's the difference. That's the terminologies that we use. The other, this could be number one. The other, number two, could be where we have equity. In IS, where we have equity, you will find that when we come to public sector, or the IFRS or IFRS 1, we have what we call the net assets. We have net assets stroke equity. So once you have equity here, in the public sector, we call it net asset stock equity, because equity section within the private sector comprises of the shareholders, the share capital that they have been contributed by the shareholders. But here we have the government as the shareholders. Here we don't mainly have shareholders. We don't necessarily have shareholders in public sector. That's why they are calling it net asset stock equity. So it is just, we just have the change of names, but it's ideally the same, because equity is just changing to net assets. Even these statements are going to be changing. The financial statements will be changing to something surplus or deficit. We have been saying within the public sector entities. Even the other major difference, I think the major difference within the IS1 and IPSAS1 is on the formats. The format is the one that causing the major difference. The formats that all the structures of these financial statements, they are very different from the IPSAS and also from the IS. They are very different from the private sector and the public sector entities. Just like as I said, because once you are in the private sector, what you are going to be looking at, these formats are going to be different. The reason is because once you are looking for profit or loss within the private sector, this is private sector. And of course, once we know that the profit and loss, it means this one is going to be an income statement, or what we call a statement of comprehensive incomes. So it will be an income statement or statement of comprehensive income. Or what we call the statement of financial performance. So you are seeing the names that we call within the private sector. So these are some of the names that we call within the private sector. But when you go to the public sector, we call them statement of financial performance. So you see the difference. This side, this one is now in the public sector. Reason is because in the private sector, you are going to be looking at either a profit or a loss. And here in the public sector, for us, we are only looking at a surplus or a deficit. Revenue, is it higher than the expenditures that we have incurred, so that it can arise into a surplus, or we have spent more than the money that we had to give us a deficit. So because we all know that these private sector entities, they don't come into existence to make profit. They don't exist to make profits. So the intention or the objective is not about profits, and it's not basically the intention. It would be unfair for, let's say, a government hospital. Let me not look at those that trade. Let's say it would be unfair for someone to charge you for using maybe a road. Of course, we have some roads where they charge you, but we shall look at that, because there is how we handle that. Even the money that is supposed to be charged should be at least maybe to cover the initial costs that were incurred in the construction, especially if, let's say, the government borrowed money to construct and it has to pay back. Just like the way you look at government schools, they are not supposed to be charging maybe tuition that is higher than that is charged from the private universities. So you find that we are going to be having that kind of deviation, because what they are trying to, the reason that's why they are charging you lower is because they are charging you the cost. They are charging you an amount to cover the costs, maybe the minimum cost that was incurred. But you find most of the roads in Kampala, most of the roads outside Kampala, they are for free. You use them, you don't pay. Even though you pay taxes to make sure that they are there, but they don't, when they come into existence. So that's why we are saying that they don't exist to make profits. So, and most of the times you'll find that it will be actually, because now for you can make a surplus. You can make a surplus. A surplus would mean that there is something like a profit. But once you make a surplus, you must explain, because by the time you ask for money in the budget, there must be expenditure line that is going to consume that money. So you will be asked why the money is still there, yet some of the things that you had budgeted for are not yet done. You'll find yourself explaining why money is still there, yet you requested for it and you have not done what the money is supposed to be used for. For example, I can give you a scenario. You can say that maybe in your budget, let's say a given district, a given local government had a budget of, let's say, 10 billion for a given quarter. Let's say for one quarter they had, just giving an assumption, if let's say you had a budget of 10 billion and you find yourself utilizing only 5 billion, the question is, why did you ask for that money? Or have you made sure that the expenditure items that you put in the budget have been met? Of course, we know scenarios that you may have a budget of 10 billion, but it doesn't mean that they will actually give you the 10 billion. Because once they go into appropriation, you may find that money is not actually there for that quarter. And maybe they promise you we shall add on in the next quarter. Some of the things that are not done, maybe they will be pushed to another quarter, depending on the amount of money. Because you can have a budget of 10 billion, but you find that the ministry has managed maybe to forward maybe like 8 billion. Of course, some of the expenditure line items that are supposed to be for 2 billion are not going to be worked on because money is not there. But if money is there, you require 1 billion was given to you, you must explain why some expenditure line items were not catered for yet the money was sent. So that's why we are saying that these are profits, because even though you have saved the 5 million and you still have it, but you have 5 schools, and at the end of the quarter you have managed maybe to construct 2 schools, and you still have this money on the account, it means that the other 3 schools that are not yet constructed, you've denied the people that would have enjoyed or that would have utilized those schools, because you have not constructed yet the money was there. You must explain why. Is it because maybe the school where you had planned to construct the schools, maybe the land had some conflicts, you had not yet procured the land, maybe you had to construct a given road, but maybe you have not yet compensated the people where the road is going to be passing. So you must find a reason to justify the remainder of the money that you have not utilized. So that's what we are talking about here, that they are not basically here to make profits, but to provide services. Once there is a surplus, we welcome it, but it shouldn't be at the expense of other people. You have denied people money, but the money is still there, but for you want to show your financial statements to actually show a surplus. It doesn't work like that, which is contrary to the private sector, because for private sector, they can give you 1 billion and they expect you to make 2 billion. And once you do that, they will say the person is actually performing well. So that's something that is going to be very important as we look at the objective, because these objectives are very, very important, and they are very different in both the way they are done under IS1. And they are the same financial statements. They are the ones that we are going to be preparing: the balance sheet, the income statement, and also the statement of changes in equity or net assets, and also the statement of cash flows. So all these will remain the same, although what is going to change are the names. Because the names are going to be changing, we need to know what are the terms that we are going to be using. Instead of saying a balance sheet, we shall be calling it a different thing. We shall go through some of those things. Because maybe just to give you some example, if you look at how we've been talking about in financial reporting, we've been saying that statement of cash flow, but here we call them cash flow statements, which is basically the same, but that's how they are pronounced, or that's how they are going to be written. So we want to go to the next video where we are going to be talking about the IFRS statements. So that's what we are going to